All down. All silent. Going. Go. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another edition of Current Market Insights. I'm your host, Ciaran O'Brien, and with me, as always, is Mr. Peter O'Malley. Peter, hello.
Ciaran, great to see you.
Great to be with you again, mate. I want to talk today about transacting in real estate, which, strangely is what we do here on the podcast. But I'd really like to take a bit of a deep dive today into what are the actual costs involved in transacting. I think most people would be aware of the obvious ones. But I know from my time and my own purchase and other anecdotes and stories and things around the industry that there are costs that some people, particularly, if they're new or inexperienced in the market, may not realise are part of the transaction. So I thought today it might be a great idea for you to take our listeners through what are those hidden costs, or not hidden, but what are the transaction costs involved, and what are some kind of tips or strategies for people to be aware of and in many ways mitigate or plan for those.
Thanks, Ciaran. Look, I think people should be acutely aware that buying the wrong property and having to resell it can end in disaster. Now, when we say the wrong property, it can be the wrong property because it doesn't meet your needs, it's excess to requirements, it's not big enough for requirements, or the mortgage is onerous and your circumstances change and you need to resell the property. And in instances where you purchase a property and then inadvertently find yourself having to sell it within a short time frame, you really need the property market to have risen 10% just to have essentially broken even.
Is that 10% regardless of market? As in, is it 10% in Sydney, 10% in Hobart, 10% in Brisbane? Given that they're all different house values. Yeah.
Every state has its own stamp duty formula, but it ends up at about the same percentage. 10% slightly overstating it, but that's essentially what you need the market to rise by after you've purchased a property, just to be in a break-even position.
Okay, so I'll get you to break down, what's involved in making up that 10%. But one question I do have about, purchasing the wrong property, I have to wonder this is not meant to be the purpose of today's topic, but how do they end up purchasing the wrong property? I mean, what goes into that as a process that makes someone move in and go, actually, all of a sudden, we're 2 bedrooms short, or the mortgage is too high? I mean, are these not factors that should be considered before the purchase is done?
Look, I don't want to be too harsh because change of circumstances do happen. Businesses go bad, people lose their jobs, marriages fall apart. So there's a range of reasons, and when you go on social media, there seems to be quite a few accounts on Twitter, particularly, that sort of take great delight in properties that sell for less than the owners paid. And being a real estate agent and knowing what transaction costs are, I think if you take delight in that, you're a mongrel.
Yeah.
Because
there's a real cost behind that, right?
There's a real human cost behind that. Like, I'm looking at one example here up at Hornsby. To your point, I have no idea what would cause them to trade like this, but they purchased it in February 2025 for $3.27 million.
Mm-hmm.
Stamp duty on 3.27 million is somewhere in the vicinity of $160,000, $161,862 to be precise.
Yep.
They've just resold that property in August 2025 for $3,170,000.
So that's a loss from the purchase price.
It's a clean 100 on the purchase price, 161,862 on the stamp, so you're $250,000 there. Probably paid someone $60 to sell it, so you're out to $320 odd there. You probably paid moving costs in and moving costs out, so let's just round that out at 10. You've probably paid another 6 or 7 in legals, and I dare say you've done some improvements to the property in the time that you've owned it. So a disastrous outcome, heading towards $400,000 loss, even though the difference between the purchase price and the sale price was only $100,000 less.
Yeah.
Now, the most onerous cost when it comes to transaction costs is clearly and indisputably stamp duty. Because since I joined real estate, the stamp duty chart has never changed. The higher the price, the higher the percentage you pay in stamp duty.
Yep.
So that was just classic bracket creep buried into the stamp duty equation. So, for example, in 2000, when I sold my first house for $420,000, I think the stamp duty percentage then was about 3.8%. That same house now, it recently traded for, I think it was 2.1 million, 2.2. But stamp duty has a sliding scale, but the purchasers would have paid somewhere around 4.5%, heading toward 5% stamp duty on that one.
On a much higher price.
Yeah, for the same property. So, and then if you go higher again, when you get into the 3 and I think it's maybe 5 or 6 million, you get further accelerators where the stamp duty above a certain price point kicks out to being 7%.
Yeah, wow. Which is substantial.
Yeah.
Right?
So when you're talking these numbers, stamp duty at 161,000 on 3.27 million, that's essentially 5% right there.
Yeah. No, it's a big chunk. I mean, stamp duties, it's one of those interesting topics, right? It's, my understanding of it is it was ceded by the federal government to the states as an incentive in the 60s or 70s, never really vanished. The states have realised how valuable it is to their coffers, and it is disproportionately disadvantageous, I think, to people looking to transact in a modern era. Given, this is a bit of a segue, I guess, but given that we, in a housing crisis in Sydney, we don't have supply, do you think that there's ever going to be any real movement on stamp duty to make it more enticing for people to downsize, for transaction for the sake of, in many ways, freeing up better? You often talk about the average composition of the house and how many people are utilising to bedroom ratios and things like that. Do you think there'll ever actually be government incentives to maximise that equation and make it more beneficial to everyone?
Stamp duty?
Yeah.
Well, Dominic Perrottet went as far as introducing it, didn't just talk about it, he introduced it. It was in for the last 6 or 7 months of his government, and then Chris Minns tore it up as soon as he got into power.
Yeah, this is the lifetime kind of, annual tax.
Annual property tax as opposed to upfront stamp duty. And it would have collected more over time as an annual property tax. But if that were introduced, it's a much fairer tax spread over a longer period of time, where stamp duty punishes those that are trading and has all sorts of unintended consequences and side effects as to how the property market operates.
Yeah, I wonder whether, New South Wales governments love to shoot down the opponent's work and then redo it in a different format. I wonder if Chris Minns, as part of his housing reforms, will ever do something similar here. Okay, so we talked about an example of transacting at a loss and that being a substantial kind of, or maybe an unexpected fee for those operating in the market. Are you able to kind of talk to our listeners a little bit about just what kind of makes up some of the other costs? I know you mentioned them briefly. There are some legals, there are some agents' fees, there are some et cetera, et cetera. But outside of stamp duty, which we know can be a little bit punitive, it is expensive, and it can be something that a lot of buyers don't necessarily consider when they come to market. What are the major components that do make up all of the kind of transaction costs?
So you've got stamp duty.
Are there any that buyers or sellers can, kind of work around or mitigate as part of the process?
Well, look, about the only ones that you can mitigate is moving costs. You can hire a utility or a van and move yourself.
Muscle cost.
Good luck with that.
I've done that many times.
And you can sell without a real estate agent. Can you get full market price? Maybe, maybe not. A little bit like being your own removalist. Good luck with that.
Yeah.
But essentially, it would be ill-advised to do your own legals. It would be ill-advised.
Are you allowed to? Is there any restrictions?
Yeah, if you make a mistake, it's on you.
Right.
Yeah, but you can self-act. Highly ill-advised.
Yeah.
Yeah. And the vendor's lawyer or the counterparty's lawyer will probably end up having to coach the person through because it's just too complicated and it'll be a disastrous transaction. But again, good luck with that. So realistically, very few people opt to sell their property without a realtor. Very few people, even less percentage of people, do their own legals. Very few people, if any, do their own removals. So in theory, yeah, you can reduce the transaction cost, but in reality, not really. So that's where I come back to that point. You can see if stamp duty is swallowing 5% straight off the bat when you purchase the property in transaction costs, you can see it doesn't take much with everything else that goes in it to run up to 10%. So when you do see a property sell for a modest loss or even a modest gain, in real terms, that can often be a nasty financial loss for someone.
So what about one of the other components or another major component that contributes to transaction costs in capital gains? So, people that are not transacting in their primary place of residence are activating a capital gain event. How does capital gains work in those kinds of scenarios? So let's assume, for the sake of our example, that the property in Hornsby was an investment bought for their children, and they had to sell for whatever, not arbitrary, but whatever reason they needed to sell for. They've accrued this incredible loss. How does that factor into capital gains?
Okay.
Can they claim that as a loss?
Yes and no, not all of it. So stamp duty is not a tax deductible expense for investors.
Right.
So you're wearing a clean half of the transaction costs, whether you're an investor, an owner, or occupier. You're wearing it regardless.
Yeah.
So there's no benefit there. Yeah, if you've purchased an investment property and you sell it for a loss, the agent's fees and the legals on the way in, on the way out are a tax deductible cost. There'll be no moving costs on an investment, of course, and you can write off repairs and capital improvements that you've made on the property if you have done any in that time. So there is some taxation relief, but all it's doing is slightly minimising the loss. If you're paying tax, you're making a profit, and if you're claiming a tax deductible, carrying a tax deductible loss going forward, well, you've still got a loss of some description. Yeah.
So can you take our listeners then, if you're happy to, an example of, let's assume, again, just working with capital gains, because I think it is a slightly confusing topic for a lot of people. Let's assume in this scenario that the house was sold for a modest profit, and factoring in stamp duty and moving and all the legals, et cetera, they've broken even, or they.
Well, you can't factor in stamp duty because it's not a tax.
Sorry, it's not. No, but I just meant in the sale price. So let's assume they paid 3.1 or 3.2, and with all of their sale price, excluding all of the costs, the transaction costs, they come out with a slight capital gain. Let's say it's 100,000 or something.
Yep.
How exactly do they calculate the gain itself? Because I think
roughly 25% of the gross capital gain, provided you haven't bought and sold inside 12 months.
Right, and it's higher if you've done it within 12 months. Is that correct?
Because you've treated it as a trader rather than a capital gain.
Yeah. Okay. All right. And then outside of primary place of residence, are there any other factors that minimise the capital gains, like levy or fee that you have to pay, other than it being your primary residence or holding it for a certain amount of time?
No, the primary residence is a tax-free sale, and that's why we've got this reason why we've got this massive wealth inequality in society at the moment, because a lot of people over a sustained period have used that vehicle to create massive gains for themselves, and we've got baby boomers now sort of selling down, assets that they paid 1.5 million for, and they're selling them down now for 8 and 8.5 million, and there's essentially, what's that, $7 million tax-free gain.
Yeah.
What other area of the economy can you profit by $7 million and not pay a cent in tax? And I'm not saying
Bitcoin pre-2020, mate.
Well, I wasn't in on that, unfortunately, but
Me neither,
fortunately. But the point there being is that it's a very, very generous system that we have for homeowners that make a big gain, and unfortunately, if you achieve a loss, you own the loss. So when you make a loss on your primary residence, you can't write that off on tax.
Yes. Yeah. But if most people in Sydney property that have had a house for any period of time, that's a highly unlikely scenario.
Well, look, I gave you one example in Hornsby. No, that's the point of today's podcast, right? Is that there's a lot of people that lose out there, and it's very painful. So going back to one of those accounts that we're talking about, there's a Riverview house here where they paid $6.5 million for it in December 2022.
Yep.
Think of all the holding costs, the interest costs, beautiful home. Probably spent teething costs. Now, let me give you an idea of stamp duty on $6.5 million. I'll just quickly go to my calculator here.
Substantial, regardless.
So just looking at that, Ciaran, stamp duty on $6.5 million is $340,000.
Yeah, wow.
So that pushes the base price of our subject property up to $6.84 million. And that particular home in September 2025, 3 years later, is on the market with a fixed asking price at $6.3 million.
Wow. So again, for the scenario, they're $500,000 behind just before they even sell the property from where the value was last time. And that excludes all the other things we talked about, the legals, the moving costs, the agent's fee on $6.5 or $6.3 million property is going to be substantial. So they, ultimately they could walk away with quite a bit less than $6 million, right? Yep. Even at 6.3.
Yep.
Yeah, that's a significant cost. And I don't think...
So there's another one here. I'll give you another good example here. One in Seaforth, sold in September 2021, the peak of the market, that bull market, $3.19 million. It's just resold in September 2025, 4 years later. They made a gain. They sold for more than they purchased for. They sold for 3.3.
Yep.
So that's obviously $110,000 more, but clearly that does not even cover the stamp duty back, and that's
which is about 160 odd, same as the other one. Yeah.
So essentially, if you buy for 3.19, you really need to sell for 3.4 or better to be getting your money back.
To break even, yeah.
To break even.
It's important for our listeners to break even at 3.4 to 3.5. That's not to make profit. And I actually wonder how many people don't realise that. When you buy a property and you think, oh, look, I've been in it for a number of years, we've paid into the mortgage, etc. Let's just sell and take all our equity and buy something else. There's probably not that much equity at the end of it, depending what your rate is and how much you're paying and all. There are other factors, but 5 years, 10 years of mortgage payments may not actually have gotten you all that much equity when you consider all these other costs.
Yeah.
Yeah.
So there's a massive cohort in Sydney and across the eastern seaboard of Australia that are sitting on massive tax-free paper gains, and they do become the subject of criticism because they are enjoying these big, massive paper gains, having bought in the early 90s, say, and selling in 2025, and it's essentially, it's nearly the equivalent of selling a company, small company, the profit that's there for them. But equally, there are many people, like we've just outlined with those examples, who have purchased and resold for around, in percentage terms, around the price they paid, a little bit more, a little bit less, but you can see that becomes a devastating loss on the bottom line when you take all the transaction costs into account. And where I see this all the time is in the gossip columns. Some celebrity will buy a house for $7 million, spend $1.5 million renovating it and selling it for 10, and they're saying $3 million windfall. And it's like, there is no $3 million windfall there. They'd be lucky to be breaking even or doing much better.
Yeah. Yeah. Look, very, very true. Final question then for you, Peter, before we wrap up. If any of our listeners out there are in the process of kind of selling, buying, whatever, is there a good resource or a person that, an agent or an accountant or a lawyer, like who's the person to talk to, I guess, to get a better understanding of all the elements involved? Because obviously the agents have their own things that they're interested in, their own biases to a certain extent. Conveyancers have their own expertise area. But is there like a good central resource that people can go to and get all the info they need to understand all these costs before they really commit?
There's not really, no. You've got to start pulling it together yourself, Yeah, I say to people who are buying and selling is that buying and selling is a full-time job as a consumer, but it's a job you didn't know you applied for, but you've suddenly got when you're doing it. and it's immensely distracting because you're still trying to do your Monday to Friday job to the best of your ability and what's required of you, but you've got this other high stakes game of poker called buying and selling real estate happening on the side.
Yeah, it's amazing the amount of people who say to me, what do I need an agent for? I could just sell my own house. And I tell them, well, absolutely, mate, go for it, because there is so much more work involved and so much complexity and so many layers of legals and everything that you don't even understand, and you still want to come to work and do your normal job. Best of luck. It's hard. Yeah,
it's a shame that the real estate industry has got itself to a point where it's trivialised like that, because the consumer doesn't respect, the depth of what's involved, because agents are, too often showing themselves on social media as being, all flash and go. But even the agents who are doing that, the majority of them behind the scenes are working very, very hard. And the Hollywood lifestyle that some agents in the industry promote, it's either a complete illusion or it's a tiny fraction of what their working week looks like. And it shocks people. You've seen it yourself here in this business. It shocks people who come in here and think that real estate is just standing at an open house and someone says, I want to buy it, how much do I have to pay?
And you get a free Mercedes or
That's
whatever.
it.
Yeah. It doesn't work like that.
And then you come into the industry and they realise the hours and the meticulous grunt work that needs to happen behind the scenes for a successful outcome on the day.
Yeah. Oh, look, I think that's a whole other discussion, but people certainly don't appreciate how challenging it is. Look, really great chat today, Peter. I appreciate the topic. I think it is a confusing one, and one that we certainly have, we will explore over time, and it will continue to be a thing. And I certainly myself hope that the government does find a way to incentivise property exchange, because I think we do have a lot of locked up properties that could be better utilised if the government was a little bit more kind of supportive with the way taxation works. That's for sure. But I certainly appreciate you coming in and having a chat.
Thanks, Ciaran.
And thanks to everyone for listening to Current Market Insights. We look forward to speaking with you next time.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.